So where did this whole idea of the downward pressure in commodities actually come from? Well, to understand that, we have to take a look at the long-term commodity cycle. And this is the long-term commodity cycle, and usually about once a year I like to revisit it because it's an excellent roadmap on what we can utilize not only as commodities traders or analysts, but also as Ellioticians. Now, what I've actually identified here is the basic 30-year cycle in commodities. And that's a 30-year cycle from top to top to top, and also it's a 30-year cycle from bottom to bottom to bottom. Now, what's interesting about this cycle is that the up moves typically last about 10 years, and it's the down moves which last about 20 years. Now, a great example of this in force is simply the price chart of gold. Here's the 1980 top. We bottomed in 1999. And one thing that's very important about this cycle, in the long-term commodity cycle, these are just rough numbers. Okay, so it's possible, for example, if we want to top in 2009 or 2012, like many commodities actually did. But this is just a general benchmark of what we tend to look for. Now, if we go back to our commodity cycle here, a long-term commodity cycle in gold, here's the 1980 peak. Here's the 1999 sell-off. So here we had 19 years to the downside, and then we actually had, let's say, 11, 12 years to the upside into 2011 for our long-term gold top in this market. We also take a look at crude oil, for example. 1983, we sell off into 1998, roughly about, say, a little bit, not yet 20 years, but close to 20 years. And then we see the big move to the upside. Now, this advance into the 2008 high did indeed last 10 years. So my overall outlook for commodities is that we've actually entered into a secular bear market in commodities. Now, what's very important to understand about the long-term commodity cycle. Oh, here's the 10-year advance in soybeans. We go from 2002 is when we actually bottomed here, or when we began turning up. The actual lower price occurred in 1999, but from 2002, 10-year advance into 2012. So that long-term commodity cycle, I think, is very much still applicable to the long-term commodity markets, and it's certainly been the case for a few centuries. Now, if we look at the secular bear market phase, that would be, say, 1980 down to, say, 2000. That's that 20 years of down market. I want you to take a very good look at this, because what a lot of people don't understand about, a secular bear market in commodities is the volatility that it tends to bring. Now, if you have, say, a commodity bear market or a bear market in, say, an individual stock or some of the indices, you actually see prices just steadily, decrease. Capital appreciation just falls off the boat. But with a commodity bear market cycle or a secular bear market in commodities, that's denoted by extreme volatility. So here's our big picture, or here's our commodity secular bear market in commodities from 1980 to 2000, roughly 2002. Notice the extreme volatility. So, which brings me to the next slide, where I've actually highlighted, and notice the bold print because I want to make my point very, very clear. This is the kind of price action we can expect between now and 2030. Yes, that's 2030. That's 15 years from now. Extreme volatility. Here's the 1980 top. We sold off 46% in price. And then and then in the months that followed, we rallied 89.97%. Now, this is just one commodity I'm focusing on because it's a great example of what we can anticipate moving forward. And I'm sharing with you my roadmap, so you have my roadmap as well. So we're both on the same page of what we can actually anticipate in commodity prices over the next 15 years, because currently we're in 2015, so we have another 15 years to go before from a time-wise perspective, the secular bear market in commodities actually terminates. From this 89.97% top we saw in 83, 51.96% decline. In the months that followed, we rallied over 124%. Then we sold off 50%. 50% rally, actually 46.52%. 30% decline, followed by a 71% advance, followed by another 53% drop in prices. So again, this price chart right here is an excellent example of what we can anticipate in this secular commodity bear market: extreme volatility. So this is the overall message I want to share with you in this month's video edition of Trader's Classroom. I want to show you the logic on why I was bearish back in 2012, and looking down in many commodities into the 2015-2016 time window, which brings a good point. Back in 2012, why was I looking down for the next, say, 2 to 3 years in many of the commodities that we follow in commodity junctures? Well, if we look at this slide a little bit more closely, not in percentage price terms, but in time terms, we see something interesting develop. This initial sell-off from the 1980 top in soybeans lasted 22 months. Then we had a rally that lasted 11 months. Then we had a decline which lasted 35 months into this low. Then we saw an advance that lasted 22 months. Then a sell-off down that lasted 37 months. Back up 24 months, 2-year rally. And then we sold off over the next year and a half, say 15-month decline. Then we saw a 31-month rally, and then that was followed by a 56-month decline into this actual low in 2002. Now, if we look at the average, simply add the months of the advances and declines, we see that we have an average of about 28 months. So roughly, each of these moves last roughly 2 years. Now, if we break it down a little bit farther and look at the actual advances and declines, we see the advances last roughly 22 months, again, roughly 2 years. We also see that the declines tend to last a bit longer. They tend to be, say, roughly almost 3 years. Now, 3 years would actually be 36 months. So again, I'm just using general terms here, looking for a general time window. So what we can glean from this slide right here is that the advances last roughly 2 years, the declines last roughly 3 years, which brings us to the current slide right here. Projected 3-year decline in soybeans. Now this is going back to, this was actually September, October, August of 2012. Actually, the price high was September 2012. This is when we made our long-term forecast for a sell-off in soybean prices, where we would see soybean prices easily get cut in half and last about 3 years. Why did I make that forecast back in 2012? Well, as you can see, going back to this slide here, the average declines last about 3 years. And the average declines to the downside, if you notice the bottom numbers, 46%, 51%, 50%, 30%, and another 53%. So really, whenever we see these declines unfold, we can basically look for commodity prices to be cut in half. Now, each chart pattern or each commodity that we follow in commodity junctures, the softs, the grains, and the meat complex, each have their own personality. So what I'm presenting here is just, again, a very general roadmap of what we can anticipate moving forward over the next 15 years. We can expect extreme volatility. We can see declines last about, say, 3 years, where we should expect prices to be cut in half. And then following that 3-year decline, we can then look for commodity prices to almost double as we see another 2-year advance coming forth. Well, the reason I'm doing presenting the material this month on the long-term commodity cycle is we're very mature within the progression of not only our Elliott wave patterns to the downside. For example, in soybeans, we're identifying this as a WXY structure where we have waves A, B, C. This is an X wave, and then we're working another A triangle BC. So we're very mature in some of our long-term patterns to the downside. So make sure you take a look at this month's Wave Watch section, where I show you weekly price charts of all the commodities that we follow. For example, in OJ, we're working the final wave C move to the downside of a very large zigzag that began in 2012. Very similar to that, we are in cotton. We're very close to finishing the long-term decline. Same thing in soybeans, same thing in corn, and also same thing in wheat. We're very mature within this current typically 3-year cycle to the downside. I suspect we're going to continue to move lower in the majority of the commodities that we follow in commodity junctures, most likely until late this year, say September, October. And then at that point, this initial move to the downside within that long-term commodity cycle will be complete. And then I think the stage will be set, or everything will be really ripe for a 2-year advance where we can essentially expect prices to advance probably 60, 70, if not 80% to the upside. So again, part of the reason why I wanted to show you this material this month is, number one, explain my logic for making the forecast I did back in 2012, show you clearly the long-term commodity cycle so that you can utilize it as a blueprint for yourself, because it's certainly the roadmap I tend to follow whenever I'm doing my long-term analysis for commodity cycles, but also bring up, again, reiterate the importance of where we currently are within the initial move to the downside. We're very mature. We're coming into that, say, that 3-year time frame. This move began in September of 2012. Well, we're pushing on to September of 2015. That's roughly 3 years to the downside. So there's not much more to go to the downside, either in price and or time, meaning that the next big move, as we move into late fall of 2015 and then into 2016, in general, most of these commodities I'm actually looking to see stage very sizable advances. So that's what another message I wanted to bring to you this month.